Hi everyone. So today my group and I will be presenting more about Silicon Valley Bank's collapse. This will be the overall flow of our presentation. We'll be starting with an introduction, discussing the primary reasons for its collapse and some of the financial challenges and structural challenges that the Silicon Valley Bank went through. And also we'll go on to cover more about Silicon Valley Bank's legacy, on the impact of its collapse and alternative scenarios, talking about what could have been done differently. And lastly, we'll end off with some reflections and learnings from the whole fiasco. So the collapse of Silicon Valley Bank was a confluence of factors. We've grouped these three factors into three main categories: economic, operational, and regulatory. So on the economic side, SVB had a significant exposure to the tech sector. In fact, 25% of deposits came from tech companies. So following a 20% drop in the Nasdaq index, which reflects the performance of the tech sector, this translated to a drastic decline in the value of its loans. So on the operational front, SVB also used a lot of leverage. The bank had a leverage ratio of 12.5, which is higher than the US average of 7.5, making the bank very vulnerable to fluctuations in its asset values. Lastly, on the regulation front, SVB also failed to comply with the Dodd-Frank Act, despite its total assets growing beyond the X threshold. So SVB's non-compliance came to light during the Federal Reserve's supervisory review, but these weaknesses in SVB's risk management were not effectively addressed. So in conclusion, the collapse of Silicon Valley Bank was caused by a perfect storm of economic, operational, and regulatory challenges. So let's now dive deeper into SVB's exposure to the financial markets in its collapse. Over here, we'll be looking at four key markets: treasury, credit, equity, and foreign exchange markets. So in the treasury market, SVB held a large portfolio of treasury bonds, estimated at around $20 billion. So as the Federal Reserve increased interest rates, the value of these bonds decreased, causing SVB to suffer losses on paper of up to $2 billion. Moving on to the credit market, SVB also engaged in risky lending, particularly to high debt startups. So when the tech sector slumped, many of these startups defaulted on their loans because they were not able to pay them back, causing SVB substantial losses. Next, on the equity market front, SVB also made significant investments to pre-IPO companies. However, the downturn in the tech sector and after several failed IPOs, including the notable case of Snowflake, SVB suffered an estimated loss of $5 billion. Finally, on the foreign exchange market front, SVB also engaged in high volume trading in volatile foreign exchange derivatives. SVB also provided large-scale margin loans to traders, many of whom defaulted in repayments due to unfavorable market conditions. So these events led to a drastic fall in the value of SVB's foreign exchange derivatives and margin loans. SVB's exposure to various financial markets and concentration in high-risk volatile assets played a pivotal role to its downfall. So the rise of interest rates and market downturns, along with drastic changes in the market conditions, led to a swift devaluation of SVB's assets, causing severe losses and liquidity issues. Next, my teammate Michelle will go on to talk more about the significance of liquidity.
Good morning, everyone. So the significance of liquidity is very important because we have to address liquidity issues promptly and effectively to maintain stable financial institutions and prevent more severe consequences like the bank runs, financial contagion, and risks to the broader economy, in this case, the tech sector. When we look at what SVB faced in late 2020, right, they had experienced a sudden and substantial increase in depositors' withdrawal requests, and they did not have enough liquidity assets to meet these demands, which created a run on the bank. And this then depleted its available funds and eroded investor confidence further. There was also a big asset mismatch where SVB rolled over their short-term debt and required new funding to replace their mature liabilities. And they continued to struggle to meet their obligations, which led to further liquidity constraints. Additionally, there was also a credit rating downgrade, and this triggered deposit outflows and made it harder for the bank to borrow, exacerbating their liquidity problem. Finally, there's also this issue of short-term wholesale funding, where there was a decline in the value of the bank's assets since they were tied to the sectors experiencing financial distress, in this case, the tech sector, and SVB experienced further capital erosion and liquidity problems from this. They then experienced a loss of market confidence, and this affected their ability to recover. One of the main issues that they faced was loss of deposits, where there was a huge liquidity crisis because of the lack of withdrawal of deposits by customers who feared that the bank might not be able to fulfill their obligations. Large-scale deposits were made, and this created an even further liquidity crisis. And the bank was even unable to meet its day-to-day funding needs and honor withdrawal requests. Because of the loss of confidence, they also had difficulty in borrowing. SVB's investments in private equity funds were closely linked to high-value tech startups, which saw a significant correction. So venture capital investments suffered a significant decline when the tech bubble burst in late 2020. There was also a higher funding cost because a loss of market confidence also led to a downgrade in SVB's credit rating, making it more expensive for them to borrow funds. There was also a lot of negative perceptions and negative market sentiments impacted SVB's reputation and brand image, further eroding customer trust and investor confidence, which resulted in a loss of business for SVB as customers and clients sought alternative banking options. And with the market value erosion, we also saw a decline in market confidence, and this led to a sharp decline in SVB's stock price since it's publicly traded. The decrease in market value weakened SVB's capital position and reduced its ability to raise equity capital if needed. There was also a high level of regulatory scrutiny and a loss of market confidence, and regulators closely monitored SVB's operations, imposed additional restrictions, and demanded more stringent capital and liquidity requirements, further limiting SVB's flexibility to recover. Yeah, Heidi will now take over and go into the details of the regulatory challenges.
Hi everyone, this is Heidi. I would like to discuss with you on the regulatory challenges of the Silicon Valley collapse. First, the need for stronger risk management standards for banks. SVB failure was also attributed because of its inadequately managed with its interest rate risk. Secondly, the need for effective coordination between the different regulatories. SVB is regulated both by the Federal Reserve and the California Department of the Financial Protection Innovation. However, it was actually reported by the Federal Reserve that there was insufficient coordination between the two regulatories that actually contributes to the bank's failure. Lastly, the need for more transparent in the banking system. The collapse of SVB also have indicated there was a lack of transparency between the banks, where the bank's problem have now become the depositors rush to withdraw the bank, and which leads to the run on the bank. There are a few shortcomings on the regulatory challenges that emerged during the SVB collapse. First, the challenges is complex and interconnected. The regulatory challenges that emerge from the SVB collapse are often complex. Secondly, the challenges is because it's always evolving. The regulatory challenge emerged from the SVB collapse are evolving. Third, the challenges are politically difficult to address because it's due to the economic crisis, political environment. Last, because the challenges are often reactive rather than proactive. Okay. The broader impacts of Silicon Valley Bank's collapse. There's an increase in the risk aversion. SVB collapse led to the heightened risk aversion among the financial institution, making it difficult for the business to access the loans and credits. Secondly, the tighter lending standards. Financial institutions are tightening up the lending criteria, which actually affecting the business eligibility for credit. And third, the increased scrutiny from the regulators has intensified their oversight of financial institutions, which leads to more frequent and examination enforcement action.
Thank you, Heidi. So I'll be sharing what could have been done differently to prevent or mitigate the collapse of SVB. SVB could have implemented better risk management practices, such as regular stress testing its balance sheet to assess potential vulnerabilities and monitoring their exposure to risk. Based on the stress testing, they could have also diversified its investment portfolio by spreading its holdings across various asset classes to reduce exposure to market fluctuations. They could have also implemented more effective liquidity management strategies, such as maintaining higher levels of liquid assets or establishing contingency plans to assess emergency funding. In order to reassure customers, SVB should have improved its communication by providing timely and transparent information about the bank's financial condition to prevent the likelihood of a bank run. So based on the lessons learned from SVB as shared previously, there are implications for financial institutions and regulators as well. Financial institutions should regularly evaluate and adjust their risk exposure to maintain stability and resilience. They should also maintain adequate liquidity buffers and have contingency plans to address liquidity challenges promptly. They should proactively communicate their financial health, risk exposures, and contingency plans to build trust and mitigate unnecessary panic from customers. Regulators play a critical role as well in ensuring the stability of the financial system. They should conduct regular examinations and enforce prudent risk management practices and intervene promptly when vulnerabilities are identified. Regulators should enforce rigorous capital requirements to ensure that financial institutions have enough buffers to absorb losses and protect depositors. Regulators such as the central banks should also adopt gradual and well-communicated interest rate adjustments to minimize the disruption to financial institutions. So apart from financial institutions regularly reviewing oneself, regulators should also conduct thorough and timely examinations to employ robust risk surveillance systems over these financial institutions and intervene promptly when required. Next slide. I will share some ethical concerns surrounding SVB's actions. So SVB's decision to increase its holdings of long-term securities without managing and disclosing the associated risks raises ethical concerns. Banks also have an ethical duty to prudently manage customers' funds, as they have a duty of care it owes customers. SVB in this case prioritized its own profitability over the interests of its depositors. As SVB failed to comply with regulations related to risk management, disclosure, and capital adequacy, it also raises questions about the bank's ethical responsibility to operate within the legal boundaries and uphold its industry standards. Ethical considerations also arise in terms of the potential harm it can cause to these stakeholders and the responsibility to consider their well-being in its decision-making. In conclusion, to date, the effects of the SVB's collapse persist in 2023, requiring careful and proactive measures. The collapse of SVB serves as a reminder of the critical importance of prudent risk management in the financial industry. Moving forward, lessons from SVB should guide financial institutions and regulators to strengthen risk management and regulatory authority to ensure the stability, resilience, and robustness of the financial system. Thank you.